welcome back. So, in our last explainer, we looked at the top half of a profit and loss statement. How a company actually makes its money. Today, we're flipping the coin and looking at the other side. Where does all that money go?
You hear that phrase all the time, right? In business news, in meetings. So what's the bottom line? Well, guess what? It's not just a saying. It is a real, actual number on a financial statement. And by the time we're done here, you'll know exactly what it means and how to find it.
At its heart, business is pretty simple. You've got money coming in, that's revenue, and you've got money going out. Those are your expenses. The difference between the two, that's your profit. We already covered the revenue part, so now it's time to follow the money out the door and get a handle on the expense side of the P&L. Okay, so here's our game plan for today. We're going to start by decoding a company's expenses, from what it costs to literally make their products to just keeping the lights on. Then we'll get into a concept that sounds tricky, but is super important: depreciation. And after that, we'll put all the pieces together to calculate that famous bottom line and wrap up with a number that every investor watches like a hawk: earnings per share. All right, let's dive in and start decoding. See, the expense section of a P&L tells a story. It's the story of every single rupee the company had to spend to make its revenue. It's a detailed account of what it truly costs to be in business. So first up are the most obvious costs, the money a company spends to physically create whatever it is they sell. For manufacturer, like the company we're looking at, this is the stuff happening right on the factory floor. These core production costs usually boil down to a few key things. First, and this is the big one, you've got the cost of raw materials, the actual lead, alloys, and parts needed to build the product. Then there's something called purchases of stock and trade. It's just a fancy way of saying finished goods that the company buys just to resell. And finally, you get this kind of weird line item for any products they made but didn't sell this year. Yeah, I know. Seeing a negative number, especially in parentheses like that, in a list of costs feels wrong. It almost looks like the company is making money from an expense. But it's actually just a clever bit of accounting, and I promise, once we break it down, it makes perfect sense. So here's the key principle. Accounting rules state you can only count an expense against the revenue it helped create in the same period. Think about it. If you made 100 batteries, but you only sold 80, it wouldn't be fair to match the cost of all 100 against the income from just 80, right? So accountants temporarily deduct the cost of those 20 unsold batteries. That's why the number's negative. The cost hasn't vanished. It's just sitting on the sidelines, waiting for those batteries to be sold next year. Okay, next up are the costs of just, running the business. Making the product is one thing, but you also have to pay for everything else that keeps the lights on and the doors open. We call these operational expenses. These usually fall into a few main categories. You've got employee benefits, which is exactly what it sounds like, salaries, benefits, and so on. Then finance costs, which is mostly interest paid on any loans. And then you've got this big slice called other expenses. This is the catch-all bucket for everything from advertising to rent to office supplies. And pro tip, when this slice of the pie is really big, that's a signal for an investor to go look in the notes of the report to see what's really in there. And when you put these numbers into context, you can find some pretty powerful insights. I mean, just think about this. A company that's making almost 3,500 crores in revenue is spending less than 5% of that on its entire workforce. That one fact tells you a ton about its business model and its cost structure. All right, let's tackle a big one: depreciation. This is an expense, but it's a special kind of expense because no cash actually leaves the company's bank account for it each year. Accountants have a name for this. It's a non-cash expense. The core idea is actually really simple. Let's say you buy a huge, expensive machine for your factory, and you know it's going to last for 10 years. Well, it doesn't really make sense to count that entire massive cost as an expense in year one, does it? Instead, you depreciate it. You spread that cost out over its 10-year useful life. And by the way, when you do the same thing for something you can't touch, like a patent, it's called amortization. This example makes it totally clear why this is so important. Imagine a company buys a big new server. Now, if they book that entire cost all at once, their profit for that year looks really, really low, right? It gives you a skewed picture. But if they depreciate it, spreading the cost over the server's 5-year life, the profit number on the right gives a much more stable and accurate view of their real earning power. That is a fantastic question. You're thinking, wait a minute, the P&L only shows an expense of $13,000, but the company's bank account is down by the full $65,000. Where'd the money go? Well, that's where another financial statement comes into play, the cash flow statement. The P&L tracks profitability, but the cash flow statement tracks the actual movement of cold, hard cash. And just like that, we've done it. We have worked our way through all the major expenses a company has. So now we are ready for the grand finale. It's time to put it all together and finally arrive at the bottom line. The math from here on out is actually just simple subtraction. We start with our total revenue, in this case, 3482 crores. A quick aside, a crore is an Indian unit for 10 million, so we're talking about some serious money here. From that, we subtract all those total expenses we just talked about. That gives us our profit before tax, or PBT. And then there's just one last deduction. Gotta pay Uncle Sam. So we subtract the company's tax bill, and here we are. 367.4 crores. This, my friends, is it. The profit after tax, or PAT. This is the bottom line everyone talks about. It's the cleanest measure of how much profit the business actually made for its owners, after every single cost and tax has been paid. But hold on, we're not quite done yet. There's one last number right at the very bottom of the P&L, and for investors, it might just be the most important one of all. It's called earnings per share, or EPS. This number takes that big total profit figure and basically personalizes it for every single shareholder. And the calculation is beautifully simple. You just take that profit after tax we just found, and you divide it by the total number of company shares out there in the world. For this company, that gives us an EPS of 21.5 rupees. This is so powerful because it boils everything. All the revenue, all the costs, all the taxes, down to a single number that tells an investor exactly how much profit was earned for each share they own. It makes comparing companies a breeze. So there you have it. From raw materials all the way down to the bottom line, you can now read the entire expense side of a P&L statement. But, just reading the numbers is one thing. Understanding the story they're trying to tell is something else entirely. The real magic starts when you use these numbers to figure out a company's health and try to predict its future. And that's a story for another explainer.